In this video, we will be having a discussion of the accrual basis of accounting and why it is the perfect method to measure a company's financial position and financial performance during a particular financial year. Welcome to Accounting Zero to Hero. We are here to help you understand the fundamental accounting concepts through simplified technical discussions and practical applications of the accounting standards. All of this to help you go from zero to hero. Now let's go back to the video. The accrual basis is one of the two accounting methods. This particular one requires accountants to recognize or record accounting transactions or economic events regardless of whether the transaction involved cash. The other one is the cash basis of accounting, which does exactly the opposite of the accrual basis. It recognizes transactions only when cash is involved. This video will primarily focus on the accrual basis, but we will refer to the cash basis as a reference from time to time. To better understand the accrual basis, you need to know that it mainly affects two major items in the financial statements: income and expenses. If you need a refresher of these two items, we have created a video to explain what these elements are. The links are in the description. According to the requirements of this method, we recognize expenses in the period when they are incurred, regardless of when we paid the counterparty. And we recognize the income in the period when they are earned, regardless of when we received cash from the customer. But what do we mean by incurred and earned in the context of the accrual basis of accounting? An expense is incurred in the period when the company benefited from the source of the expense. For example, for salaries, you incur them in the period when the employee rendered its services regardless of whether they are paid or not. Interest on bank loan. You incur them evenly throughout the year because this payment is for the use of the money the bank lent to you, regardless of when the interest payment falls due. Insurance. You incur insurance expense on the period when you are covered by the insurance regardless of the payment terms. On the other hand, an income is generally earned in the period when the goods are sold or services are performed to the customers, regardless of whether the company has been paid or not. We will leave it at that for basic accounting purposes and not deal with the complicated revenue recognition criteria from the international accounting standards. The accrual basis is actually an application of the matching principle in accounting, which states that the related revenues and expenses must be matched in the same period. The matching principle, and eventually the accrual basis, recognizes the fact that the revenues we deliver to the customers are not produced out of nothing. The simplest example we can generate is when we are in the merchandising business or buy and sell of inventories. The income from the sale of the inventories are matched to the cost of these inventories that were sold. When we recognize both in the same period, we will have a view of how much gross profit we are earning for each inventory we are selling. As you may know by now, we have two main financial statements: the balance sheet, which measure financial position, and the income statement, which measure financial performance. By removing the cash aspect of the transactions, the accrual basis provides a more honest interpretation of the company's financial performance during the period because we are recognizing items when they should be recognized and not when they are paid or collected. This basis provides for the real economic performance of the business during the period. We can make this clearer if we show an example. Consider a series of transactions wherein the company rendered services to the customers in year 1 amounting to 100,000 but were only paid in the following year. To be able to render the services, the company paid for supplies amounting to 140,000 in year 1, which was only 50% used in year 1, and the remaining was used in year 2. In year 2, the company rendered 150,000 of revenue from customers, and all were collected during the same year. Under the accrual basis of accounting, the income and expenses were spread over the correct periods, which effectively shows a net income of 30,000 on year 1 and 80,000 in year 2. However, if we follow the cash basis of accounting, it will show a net loss of 140,000 in year 1, while a 250,000 net income on year 2, which isn't exactly true because some of the revenues were actually rendered or earned in the previous year, and some of the supplies expenses were incurred in year 2 as well, but all of them were paid in year 1. So the cash collections are shown separately through the Statement of Cashflows, which is an entirely different financial statement. It shows more details of how cash is being managed within the company and is a perfect complement to the accrual basis. Additionally, in certain jurisdictions, cash basis of accounting is actually acceptable especially for small businesses, but in general, when in doubt, use accrual basis of accounting. This video is the first part of a mini-series on the accrual basis of accounting, where we will talk about what are the specific adjustments that you need to do when you are preparing financial statements under the accrual basis. I hope you learned something from this video. If you would like to see similar content, don't forget to subscribe and click the notification bell. See you!